Hi, this is Terry, and I'm going to do a short video, and it's on segment reporting. This particular topic comes out of the Garrison textbook and may or may not be in the textbook for this course, but it's an important topic, and so you might just be learning a little extra. So let's kind of set the foundation of our starting point. When we create the financial statement. So we create the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. Those are all done for the entire company. It makes sense in managerial accounting that what we may want to do is some segment reporting, in other words, a subsection, and look at information or data constructed based on each of those individual subsections. So it might be something like a sales territory or a division in a company. It might be individual products that we're looking at, or individual salespeople or customers. So anything that we have collected data that we can make a subset of data, then is something that we can do. So we can define it. There is no set definition of what segments gap, follow gap or not. The one issue that comes up is that some of the common costs or the fixed costs can be traceable, and some of those fixed costs are common. So for the example I give in class is, if we are running a grocery store, we know that the cost of the refrigerators in the meat department can be charged to the meat department. The refrigeration of the produce, the vegetables, can be charged to the produce department. But what do we do about the checkout people and the cash registers on the front line? So anything that is helpful to both but cannot be attributed to only one or the other, then we have to use this concept of a common cost. So let's move down and take a look. And I'm going to bypass that so we can just look at numbers. It'll make the most sense. So if we look at the sales here of $1.5 million, we can break that down and see, okay, of that sales, 9/15, 900 over 1.5, is is attributable to the meat department, where the produce is 600. So again, we have a total of 1.5. The variable expenses can be broken down, and we see that that's 810, gives us a contribution margin. The traceable fixed expenses, so in this particular situation, we have 230 that can be traced to the meat department, whereas we have 170 that's traceable to produce. Then we have this other section here that is common fixed expenses that we just can't trace. And I see that jumped up, so I'll hit a return on this. Sorry, it jumped on me. We see that 240,000 is just not attributable to one or the other. Therefore, what we have to do is to look at this in this format. We have to use this format. If we took that produce and broke it down to the difference between the fresh produce, and I got to turn my smart feature back on and click and go back to pen so that it works. Then I'll hide this again. So if we go back and take the produce and take these numbers and copy them here, now we can break it down into fresh produce versus packaged produce. But you'll notice that of this 170,000, we can trace to fresh produce in the packaged produce. 40 and 60 makes 100. But of that 70,000 there, of that 70,000, we just can't trace it. We know it helps produce, but we can't attribute it to whether it's the fresh produce it helps or the packaged produce. So again, we have to have this extra line in here that is the common fixed. And here's the moral of the story, and that is if the segment margin is positive, which the packaged produce is not, then we would keep it. Since the packaged produce is negative, then what that's telling us is the packaged produce is costing us money, that what we should do is go with only the fresh produce. This may or may not make business sense because you may lose customers by not having both. But from a strict accounting perspective, the answer is get rid of the packaged produce. Again, the accounting world is there to support numbers to give to managers so they can make these decisions, but they need to know that the packaged produce is losing them money. And then they can take into effect, take those numbers into account in deciding what to keep and what not to keep, and what the implications would be if they quit selling that product to the overall business. So I think that's probably enough. Maybe quickly just hit this next slide here that says what would happen if we took the produce and we did just get rid of it because it's losing us money. If we took the fixed expenses and just said, what we're going to do here is we're going to take that 240 and we're going to take 900 over 1.5, so 9/15, and allocate it to the meat, and then take 6/15 and allocate it to the produce. If we would use this format where we take those fixed expenses and charge them, it would show net income for the produce is that we should get rid of it. So that's why you got to come back up to this number right here. The segment margin is positive. As long as that segment margin is positive, we would keep it. So to prove that this is correct, the lower section here shows you that if we got rid of all these numbers here and kept the meat numbers, right? That's all we would have is the meat. You see that ultimately what we do is we lose 30,000. The reason that we have to put this whole $240,000 here, kind of trying to make an arrow there for you, 240,000 there, is those costs don't go away. So we're talking about property taxes, we're talking about factory insurance, those kind of issues. So even though above they're allocated, when we get rid of the produce, then the whole 240 now has to be absorbed by the meat, and when we do that, we see that the meat goes negative. So we have to go back again, like we said before, we have to go back up to this rule that as long as our segment margin is positive, we would keep that product line. All right, I think that's it for this topic.